Okay, hi everyone. Thanks for being so patient with us. My name is Brian. I'm one of the co-founders of FundPlaces, and I have the rest of my team here: Stephen, Marian, and Kok Yong and Xing Yao outside.
Hello.
So maybe before we start, can I get just a show of hands to understand the crowd a bit better? Who has heard of Bitcoin? Sure, everybody right by now. Ethereum, Litecoin. Okay, fewer people. EOS. Neo. Okay, obviously the guy investing in cryptocurrencies, his hand has been up all the way. And who has invested in these crypto assets? Oh, okay, not bad. Who has made money in these crypto assets? Not very hard, right? For those that didn't put up your hand, who wants to make a guess? How much was Bitcoin up from the beginning of last year till now? $3,600. No, not really. No. It was about 11 times up to now. What about Ethereum?
You went from 180 to 1,000 today, or in the morning?
In the beginning of January, Ethereum was $8, and it's about 1,000 today. So it's about 125 times. And Ripple, what about Ripple? Yeah, Ripple was up about 200 over times from the beginning of last year to now. So I guess, for those guys who put up their hand and said they made money in crypto, I think maybe they can buy us a drink later. If they accept crypto assets, that's right. So I think that's why a lot of people probably are here for this talk, right? To find out a bit more about crypto assets, a bit more about blockchain. At FundPlaces, what we're doing is slightly different. We're actually digitizing real estate on the blockchain to make it more accessible and tradable for people. Really making real estate investments a bit more bite-sized. We are a bit more focused on real estate because while crypto assets can make you a lot of money in a short period of time, we think that a large portion of your net worth should probably still be in something that's a hard asset or real estate. So that's why we have FundPlaces. If you on the FundPlaces platform, you can basically invest into different countries. So to date, we have investments in Australia and the UK, and this year we'll be opening up New Zealand as well. The returns we've gotten, unfortunately not as fantastic as 125 times, but I think it's still pretty decent for a safe asset. So on average, most of our members earn about 12% plus per annum. So do check us out, on fundplaces.com. Have a look at some of our projects there. We are quite selective in terms of the projects that we actually put on, so it's not really a free-for-all marketplace, and we spend quite a lot of time on our due diligence. So if there are no projects there, it's just because we haven't found anything we think it's worth putting out. Okay, and without further ado, I will let you guys listen to Stephen, which is the reason that you're all here on crypto assets and blockchain. Okay, Stephen.
Alrighty. Alright, thanks guys.
So today we'll talk a little bit about the kinds of crypto assets, and I understand that there is a range of expertise in the room, right? I think we have some seasoned crypto traders here who probably understand what it's all about, and I think we also have some people in the room who are other than Bitcoin and Ethereum, they have no idea what other coins are out there. All right. So this session will be basically interactive. So what I'll do is I'll go over a couple of slides, just to introduce the topic, and then after that I'll open it up to the audience and we'll do a bit of a Q&A, right? So please feel free to answer whatever questions there are, whatever is on your mind. Alrighty. So let's start. All right, that's me. Okay, I'm the FundPlaces SVP of Product and Compliance. And what I've done is I run the technology platform for FundPlaces, and I've also created the FundPlaces Distributed Asset Ledger. So it's a private blockchain where we digitize real estate assets. I work for Standard Chartered Bank, Basel II risk model governance, and I work in PayPal for fraud risk. And as you can see, I do like wearing the FundPlaces tee quite a bit. All right, so for those of you out there who are not familiar with blockchain, I would like to basically describe to you what are the key features of what a blockchain is. Right, so a blockchain is basically a peer-to-peer network of computers. Right, so basically, it's kind of like the internet that we have. Right, you have people, and they basically connect to each other, and they form this network on top of the internet. Right, now, all these computers together, they basically form a distributed database or ledger. So basically, they they basically keep all the information for a particular purpose, right? So for Bitcoin, it's payments and how much each person has in Bitcoin. For Ethereum, it's basically smart contracts. So it's not just how much Ether you have, but also the data associated with each smart contract, right? And the most important thing about blockchains, right, is that they have something called a consensus mechanism. So the whole idea behind that is that how do we know what is the actual source of truth on a blockchain? If I have a copy of the blockchain and you have a copy of the blockchain, right? And if those copies don't agree, how do we then come into agreement, right? So all blockchains have this kind of consensus mechanism. There's a way that they talk to each other and come to a conclusion about what exactly is the state of the blockchain. All right, so before we go on, I would like to just kind of open up the floor to the audience and for questions, right? Does anybody have any questions? No questions, okay.
Sorry.
Oh, yeah, wait.
Here I don't understand your description. Is there any other way of describing blockchain?
Pretty much, unfortunately, no. Right? The most important part is the consensus mechanism, right? So basically, because think about it like this. We're a bunch of friends, right? And we want to agree, we try to agree on something. So what happens is we talk to each other and then finally we agree on something, right? But no one person is the central authority and says, I say it is A. And then after that, everybody then follows him. What happens is they all talk to each other, and then after they come up with what is the truth of the blockchain. Think about it like that. Yep.
So so there's no collateral behind it. It's not as if anything securing it. It's just a common perception of what this thing is, and it's perceived that way, and there's value assigned to it. Is that what it is?
Yeah, pretty much. That's how blockchains work, right? It's basically consensus peer-to-peer networks. Any other questions?
Okay, maybe I just give the layman explanation that how I also can't understand it, right? Because the layman is the techie. So all of us have bank accounts, right? So in a typical non-distributed structure, right? Our bank account statement. Let's say I have $100 with DBS, right? The only way and reason I know I have $100 with DBS is because DBS tells me I have $100 with DBS, right? So DBS is the arbiter of truth, right? So DBS, I fully trust DBS. DBS has a database, and it's just let's say it's a single copy of a database, and that information is meant to be true. In a distributed network like the blockchain, there are multiple copies of this same database. So instead of just DBS having a database, you yourself will have the database as well. You have it, I have it. We all can have a copy of that database. And I think what Stephen was mentioning just now was more in terms of, we all have a copy of the database. So even if something happens to DBS, we all already know that, okay, yes, Ryan has $100 in his account. because he didn't invest in crypto, so he's still poor, right? So we all know that that is so we all have a copy, and hence we all can agree. So there are instances, of course, as Steve was mentioning in terms of consensus. How do we all agree that how do we all agree on which copies are correct, right? And usually in that case, in terms of the blockchain, right, how it works is that the majority usually wins. So if there are more than 50% of the copies on the chain, right, that say that I have $100, then I have $100. Yeah. So that's we can go into more detail, but that's kind of the basic explanation.
Is it like an email chain with everybody copied in it, like no central oversight to verify it? It's like self-verification because there's so many copies around of the same copy.
It's not really self-verification. It's more like basically everybody has to agree, right?
Is that example relevant?
I mean, I think if it helps you understand, that's okay, right? I mean, you can think of it like an email chain. Yeah, you could think of it that way.
So what the consensus thing, because my understanding is that all miners are competing with each other to find out the answers.
Okay.
One winners distribute the answer to everyone, and they don't just agree. That's not.
Okay. So for Bitcoin, so I'll answer that question when we talk a bit about Bitcoin, right?
Can I ask, how small can the blockchain be, and how big can it grow?
Oh my goodness, it could be extremely big. Okay, blockchains can grow at I mean, it all depends on how many transactions are happening on the blockchain and how much data is stored on the blockchain.
But
Right?
how small is it first?
Initially it's just really small. You can start out with like just a few kilobytes, right? And then after that, but what happens is as you continue to do transactions on the blockchain, when you continue to store data on the blockchain, then it will grow. And the thing is, if everybody is transacting, then it's going to grow at an exponential rate, right? But there are limits to the blockchain depending on how the blockchain grows, depending on what exactly the blockchain. I mean, some rules underlying a particular blockchain. Okay, so let's talk about Bitcoin here, right? So the thing about Bitcoin is Bitcoin is the world's first decentralized currency. Okay, and it exists completely on the internet, and there is no central authority governing Bitcoin. It is literally just a peer-to-peer network of computers talking to each other and agreeing with each other about who owns what Bitcoin. All right, Bitcoin is very special because nobody ever brought these ideas together before, right? So Satoshi Nakamoto, which is not really a real person, but a lot of people have actually tried to find out who this guy is or group of people are, right? I mean, to me, I think it's actually Hal Finney, who died, but okay, never mind, that's another story. Okay, but so Satoshi brought together cryptography, and he put together this Byzantine consensus algorithm, okay, called proof of work, and the blockchain, and created Bitcoin. So some fast facts about Bitcoin, okay. Now there will only ever be 21 million Bitcoins ever, all right. Then this is hardwired into the Bitcoin protocol. Currently there are like 16.8 million. This is as of Monday when I prepared this presentation, right. And new Bitcoins get created through this mining process, right? Mining process. And when a miner, so this mining process, what it does is the miner will get a bunch of transactions, right? And then it will try to, like you said, compete with other miners to find the answer to create a new block. And then when they create a new block, then they get block rewards. Okay, so they get new coins, new Bitcoins are created from this block reward, all right? And they are given to the miner who has solved the block. The interesting about Bitcoin is that every couple of years, like every 4 years, the mining reward halves. So when Bitcoin first came about, it was 50 Bitcoins per block, and now it's 12 and a half, right? think so. Okay, so then the smallest unit of the Bitcoin is a Satoshi. So there's a lot of, for people who are first coming to cryptocurrency, right, they have to realize that actually you don't just have to buy one Bitcoin. You can buy a really, really, really small portion of a Bitcoin. Okay, and Bitcoin can be divided into like 100 million little bits called Satoshis. Alrighty, so after this, I guess I'll open up the floor again for questions. Does anybody have any questions? Just raise your hand and ask questions. You asked a question, right, about the miners. Can you repeat your question again?
Oh, my question is just concept of
Oh, the consensus. Yes, the consensus. Okay. So miners, so if you think about it, what happens is the consensus mechanism for Bitcoin is called proof of work. And basically the idea here is that the longest chain wins out, right? The longest chain, the chain with the most amount of work, the most amount of transactions who have been confirmed, right, wins out. That is the agreement among all the nodes, right? And that's the consensus mechanism. Now the mining reward is actually different from the consensus mechanism. It's just a way to actually secure the blockchain, right? And it's a way to actually bring new Bitcoins into existence. Did I answer your question? Other questions? Yes?
All this data that keeps getting created, so Brian gives me $50 of his $100, that needs to be reflected everywhere, so to speak, right?
Yes.
So if there are a million places where that is,
yes.
Right, and so as these transactions get bigger and bigger and bigger, and it all keeps adding and adding and adding, it's a bit like something that just keeps doubling and growing exponentially.
Yes.
Where does all this data reside?
Okay, so every node on the blockchain has to have a copy of the data, right? So Bitcoin, what happens is, okay, you've heard about Bitcoin and how transactions are very expensive, okay? Because what happens is, for Bitcoin, the number of transactions that can happen on Bitcoin is actually a constant, right? It's only about 2 to 3 transactions per second. So it's actually pretty slow as compared to all other, as compared to all other methods that we have in the real world. Like, Visa is supposed to process like 40,000 transactions a second, something like that, right? And the reason why is because of certain parameters in the blockchain. So the parameter in the blockchain says that we can only create one block of transactions every 10 minutes. Okay? And this block of transactions can only occupy the space of 1 megabyte. So Bitcoin is increasing at the rate of 1 megabyte, or the Bitcoin blockchain is increasing at the rate of 1 megabyte every 10 minutes. Right? But for other blockchains, it's different. They may have larger block sizes. Okay, so they may have 2 megabytes or 8 megabytes. In fact, we'll see a blockchain later that has an 8 megabyte block size. And the length of time between blocks can also change. And then that can increase the number of transactions. Right? On the other hand, yeah, that's pretty much it.
A few questions.
Yep.
So if I were to buy a Bitcoin today, it will be one of the 16.8 million in existence?
Yes, it would be.
Okay. Next question is, who are the miners?
The miners are all anybody. The thing about Bitcoin and all these cryptocurrencies that you talk about is that they're open networks. So the software that is used is open source, and basically anybody can install it on their computer and connect to the network and actually run the software and participate in the network. Okay. For Bitcoin, what happens is you need specialized hardware to actually mine, because you need to generate a significant amount of computing power to actually find the block. Right? But to actually just connect to the blockchain, to use it, you couldn't actually do that. So anybody can actually do that.
So instead of buying a Bitcoin, I could actually become a miner?
Yes. But you would have to probably set up a mining rig, and the chance that you would actually hit a Bitcoin is quite low. So if you try to mine on this little computer here, you could probably run until the sun burnt out, right? And you never get a block reward. You'll never be able to confirm a block.
2011, 2012, you could have done that.
Yes.
Now it's crazy.
So what will happen when we reach the number of 21 million?
Then what happens is so the miners won't get any more block rewards. But what happens is that when you make a transaction, you have to pay a fee in terms of Bitcoin. So instead of getting just the block, so they wouldn't get the block reward anymore, but they would get the mining fee, the transaction fee. So let's say, for example, I'm sending money I send a Bitcoin from me to you. What would happen is, if I send 1 Bitcoin, you would get less than a Bitcoin because some of that would be eaten away by the miner's transaction fee. Yep.
So that would imply the supply of Bitcoin is finite, which it is, right? 21
Yes.
million. And you keep transacting. Eventually, transaction costs are just going to overwhelm everything else. Is that possible? In the end, you'll be all of it will start depreciating because it's all being taken by transaction costs.
What happens is when the Bitcoin is transferred to the miner still has the Bitcoin. It doesn't get destroyed, right? So the miner the miner will need to spend that Bitcoin to go and fund his mining operation. So then to pay for electricity and whatever. So so the coin would circulate around, right? Unless of course you sent it to an address and then somebody lost the private keys and then that coin is effectively destroyed, right?
But you'd be like a stockbroker that's helping you buy and sell things, and you'd be getting a cut.
Yes, but he would still have to fund his operation, which would require lots of electricity and mining equipment. Yes?
I mean, if transaction cost is an issue, then that defeats the purpose of this blockchain, which is to lower transaction costs, cutting out the central.
Okay. So when you guys have hit upon a very common problem in blockchains, now that growing pains, right, which is scalability, right? So a lot of blockchains are having problems trying to scale. Now Bitcoin, what happens is, what people are doing is that they're creating secondary networks on top of Bitcoin or on top of Ethereum to help to lower transaction costs. And that's something called like a Lightning Network, right? So the Lightning Network is kind of like are you guys familiar with Halawala? The Halawala networks or whatever. So basically the idea is that if I want to get money to you, right? If I want to get money to you, I don't know who you are, right? I know your name, but I don't know who you are. So I give money to him, and then he knows somebody gives money to you. He knows somebody else who's kind of closer to you, so he gives money to that person, and so on and so forth until the money actually reaches you, right? So Lightning Network is actually in test on the Bitcoin network, and people are hoping, or at least Bitcoin aficionados are hoping that it's going to help to reduce transaction costs, right? Supposed to, right? So what would happen is you would keep Bitcoin would be like your savings account. You would keep it there. You keep most of your money in Bitcoin you keep most of your money on the Bitcoin blockchain, right? And then if you needed to make transactions for daily necessities or whatever, you would fund your Lightning Network wallet and then transfer. Alrighty, so let's move on. Okay, so I want to talk a little bit about other cryptocurrencies.
Stephen, sorry, maybe can you just, I guess for the benefit of those people who are newer to cryptocurrencies, talk a bit about the wallets and why people are using Bitcoin in terms of how they keep your identity anonymous?
Okay. So wallets. Okay. Everybody wonders what this wallet is. Everybody wonders, is it the Bitcoin on my computer? Oh, it's on my computer. Okay. So very interesting, right? A lot of people so how do you get a Bitcoin? Right? I mean, how do you own a Bitcoin? What happens is you don't really own ownership in the Bitcoin sense is about control. So it's not like DBS says that you have $100 or something like that. Somebody else says that you have this. Basically, it's about control of the Bitcoin, right? So Bitcoins are basically associated with addresses on the Bitcoin blockchain. So every Bitcoin belongs to a particular address on the Bitcoin blockchain, right? And to spend that Bitcoin, you need to have the private key of the address, all right? Okay, so this is something to do with cryptography. Okay, so there's a public and private key cryptography. But what happens is you need this private key, and then you can sign a transaction to send money, to send Bitcoin to somebody. So let's say, for example, I want to send money to you, right? I would have to sign a transaction coming from that address and then broadcast it on the Bitcoin blockchain. A miner would pick that up, include it on a block, minus the transaction fee, and then after that it would go to that person. Right? So wallets are basically pieces of software that protect your private key, because with your private key you can move your Bitcoin from any one of the addresses that you control. So very important, keep your private key safe, use good wallet software, multi-signature, if you have a lot of Bitcoin, which I don't. Alright. So let's talk about some other cryptocurrencies, right? Okay. So as of Monday, when I created this, these are the top 5 cryptocurrencies by market capitalization. With Bitcoin at the top, granddaddy of it all. Next is Ethereum. After that is Ripple, Bitcoin Cash, and the last one is a new entrant that just came out of nowhere, called Cardano. Right? So let's talk about Ethereum. So Ethereum is a smart contract platform. Some people call it second generation cryptocurrency, but the whole idea behind it is that somebody was like, oh, Bitcoin is just for sending like money, right? But can we do something more with this? Can we do something more with blockchain? Can we like not just send money, but maybe we can program money, right? So the whole idea behind Ethereum is that it's supposed to be a smart contract platform. A smart contract is basically a piece of computer code that lives on the blockchain, and when things happen, right, then it executes and it carries out some instructions. So for example, let's say, you and me enter into some kind of agreement so at a certain date I will pay you, you'll give me some tokens from an ICO, and then after that I will give you like 10 Ether, for example. So a smart contract like that could be put on the Ethereum blockchain. Okay. So, I mean, the Ethereum basically incorporated a lot of ideas from Bitcoin, like proof of work, but it also included something called the Ethereum virtual machine to actually execute these smart contracts. It's a Turing complete language which has its own set of problems, right? But it was definitely quite a leap in terms of innovation for blockchains in general. Okay, it's invented by a guy called Vitalik Buterin, who I think is in Singapore? Yeah. All right. So some Ethereum quick effects for people who maybe they want to buy Ethereum. Okay, so there's no cap to the amount of Ethereum that's going to be mined, right? What happens is a constant amount of Ethereum is created every single year. So Ethereum basically the amount of Ethereum will grow until a point where they feel that the amount of Ethereum being lost, okay, because what happens is if you lose your private key or whatever, then the Ethereum is practically lost. So the amount of Ethereum will grow until a point where the amount of the amount of Ether that is actually being lost is equal to the amount of Ether that's actually being mined. Right. So instead of the miner, so to actually execute these smart contracts on the blockchain, right? They require gas, and gas is just priced in Ether. So basically, Ether is used to run. You need Ether to actually run your smart contracts. So an ICO is basically ways for companies to actually raise money by issuing tokens on the blockchain. And these tokens will be for anything. Some of them give ownership, some of them give utility. I mean, so for us, the kind of tokens that we issue, but it's not on Ethereum, it's on our own blockchain, is is asset backed. It represents real estate investments. Move on. Okay, so what is Ripple? So Ripple is a very strange coin, right? It is Okay, so actually it's kind of really a lot like a private blockchain. So I'm very surprised as to how the price can go up so high, but hey, nobody knows, right? Okay, the thing about Ripple is that Ripple is controlled by one entity called Ripple Labs, right? And basically, when they first set it up, it's all to do. What they want to do is they want to get banks on it to actually basically do interbank transactions, right? So it's kind of like, let's say I'm bank A and there's a bank B somewhere else, right? So if I want to make a transaction, I'll say, okay, I'll send from bank A to bank B. I'll send like $1,000. But the thing is that it's only a ledger. It's only a database. There's no settlement on chain. All the settlement has been happening off chain, right? Okay, so the thing about Ripple is that there's no mining. Okay, all the Ripple that has ever been created was created upfront, and they created 100 billion Ripple upfront. Okay. The creator said, hey man, we created 100 billion Ripple, so let's keep 20 billion, right? And then we'll take the rest and put it into give it to the Ripple Labs. And Ripple Labs, sometimes they gave it away during some in the early days. There was a story on the Bitcoin Reddit. Okay, if anybody's been to Reddit, there's a story on the Bitcoin Reddit, right? Where one guy was like, oh, in those days, 2013, Ripple was giving out like 1,000 Ripple for no reason, just giving it out, right? So I kept my wallet, and I had like 1,000. I had like 1,000 Ripple in it. Sorry, I have 11,000 Ripple in it. So this guy just took that Ripple and exchanged it for 1 Bitcoin, because obviously he's a Bitcoin aficionado. He doesn't believe in Ripple. But the idea behind Ripple is it's supposed to be a bridge currency, right? So basically, I have Ripple, I send you Ripple, you can cash it out at some gateway, right? Kind of like how some people use Bitcoin as a remittance facility, right? You buy Bitcoin in the US, you send that Bitcoin to, let's say, Philippines, and then after that, somebody in Philippines will take that Bitcoin, sell it on an exchange. Or the Ripple is supposed to pay transaction fees when you actually write into the Ripple ledger. But this is the use case for Ripple. Okay, any questions? So this is the third biggest cryptocurrency.
The ICO.
Yeah?
Is it considered ICO?
In a sense, yes. Ripple is a kind of a considered ICO. But if you think about it, because they pre-mine everything and they gave most of it to themselves, it's kind of a weird ICO. So basically, Ripple, if you think about it, they actually wanted to use it as for banks. It's supposed to be an institutional tool, and I guess they kind of glommed on to this ICO kind of stuff later on. Yep.
So who owns Ripple Labs? Is it a consortium of banks, or is it individuals, or is it a tech firm? Or?
Yeah, it's actually individuals. It's like a tech firm, basically. They try and convince the banks to actually come on board and use Ripple.
So they have 20 billion Ripples for themselves. What's the value right now of Ripple? I don't know.
I have no idea.
So they have 20 billion really, just like that?
Yeah, pretty much.
1.4.
That's a good idea, isn't it? Oh. Okay.
Any other questions about Ripple?
Ripple has a distributed ledger.
Yes, the ledger is distributed. Okay, but initially they wanted, it was open, anybody could connect to it. But what happens is Ripple, after a while, they decided that you have to you can connect to it and read it. Okay, but if you actually want to validate transactions, so they have a different process than mining. Since everything is pre-mined, there's no mining, so to speak, right? There's no confirmation of transactions. So what Ripple does is they select a few nodes. Okay, so it's actually somewhat centralized, right? So they select a few nodes, and those nodes are validating nodes. And basically, if you send a transaction to them and they don't reject it, then you can't get your transaction in the ledger. Right? Move on. Okay, Bitcoin Cash. Now, this is when people get confused. I can see the lady's face. She's like, whoa, what the hell's going on, man? Okay, so now Bitcoin and Bitcoin Cash used to be this. Before the 1st of August 2017, there was no such thing as Bitcoin Cash. There was only Bitcoin. And then they split. Now, Bitcoin Cash is what we call a hard fork. So a blockchain is just data, right? It's just data. So what happens? So let's say all together we are like the Bitcoin network, and we are all in agreement with each other. What happens if one day some people decide that, hey, wait a minute, I don't agree with you anymore. I can't, what you want to do and what I want to do. No, we need a divorce. So that's exactly what happened, right? So remember I told you that Bitcoin transactions are very slow and very expensive. So there was this religious war in Bitcoin called the block size debate, right? So I told you that block size is 1 megabyte. There was one camp that said, hey, if you want to increase the number of transactions, all we have to do is increase the block size. If we increase the block size from 1 megabyte to 2 megabytes, we can double the number of transactions. And if we increase the block size from 2 megabytes, from 1 megabyte to 8 megabytes, we can, 8 times, right? 8 times the number of transactions. Then other guys said, no, we can't do that. Because if you have very big block sizes, what happens is it will make propagation of the blocks around the network more difficult, and then after that we'll have more centralization, and then the promise of Bitcoin will be destroyed, that kind of thing, right? So there was a religious war around this, and so basically it split into two. So on August the 1st, a bunch of guys decided, hey, I don't want to agree with you anymore. So we go off on our own way. So they created Bitcoin Cash. Bitcoin Cash has 8 megabyte blocks. That's the defining feature of Bitcoin Cash. Okay. Now, if you own Bitcoin before the fork, after Bitcoin and Bitcoin Cash fork, you actually own Bitcoin and Bitcoin Cash. You actually own two coins after that. So for some people, they were like, woo, and then they just sold their Bitcoin Cash, right? Basically, it's like you get for free. Okay, because what happens is when the blockchain forks, okay, the data of the blockchain is also replicated. The history, the same history is replicated, right? Okay, any questions? Bitcoin Cash?
You only get the Bitcoin Cash if you have your Bitcoins in like your own wallet, right? It's on exchange.
Oh yes, that's true.
Yeah.
Yeah. So once again, the mantra is, please control your own private keys. Don't leave your Bitcoin on an exchange. Any other questions? Right. Okay. So finally, this is this is the fifth one. It's called Cardano, and Cardano is supposed to be a third generation blockchain. So the whole like I mentioned before, right? There are scaling problems. There are lots of scaling problems with blockchains, the public blockchains. So Cardano is supposed to be the blockchain to rule them all, right? It is supposed to solve the scaling problem, this, that, everything, right? And it's very interesting. So Cardano was basically sold, but only in, I think, Japan, right? So most of the Cardano holders are actually Japanese. And one of the interesting things about Cardano is it's supposed to be, so instead of proof of work, right, where you use the most work to decide what blocks are valid, they use a consensus algorithm called proof of stake. So the whole idea is that I am going to put some of my Cardano, ADA, right, whatever, some of my coins, some of my crypto coins on this chain. I'm going to put it as a deposit, right? So that is my stake. And the bigger the stake you have, the more likely of the bigger stake you have, the more likely that you will be able to confirm a block. That's it. All right. So it's very technical. So Cardano is extremely technical, right? But it really wants to solve like the really big problems. Okay. So if you're very geeky and you think that maybe these guys can pull it off, not sure if they can, but they're taking a very systematic approach to trying to solve these problems. Then you should get into Cardano. I'm not really sure where you can buy it though.
KuCoin.
KuCoin. Oh, okay. Thanks.
Can we elaborate more on how this is made more scalable compared to the
Okay. So, okay. The first thing of scalability is proof of stake, right? So proof of stake is supposed to be, so you all hear about Bitcoin being very energy intensive, right? Like it's super energy intensive because you actually need to do the work. So proof of stake is supposed to be less energy intensive because the whole idea is that I put my money where my mouth is, I put my stake in, and then after that I have a bigger say. Because if, for example, since I have a big stake, then I have a bigger say, and that's my consensus algorithm. So, and that takes less energy. So that's one part of scalability. So less energy is one part of scalability. Another way is that they actually, so it deviates a bit from blockchain. The idea is that, so blockchain, everybody has a copy of the data, right? But for here, what will happen is the data will be split. So some nodes would have some parts of the data, other nodes would have other parts of the data, right? So it's more of a distributed database, or kind of like what we have for Amazon Web Services. But of course, it would still not be controlled by one central authority. That's the idea behind it anyway. Any questions? Alrighty, we can move on. Okay. So how is cryptocurrency affecting property, right? I mean, one of the ways that people use cryptocurrency or blockchains in property is that they actually try and buy property, right? So this thing actually became a thing last year. Some people have actually transacted and bought houses, real houses with cryptocurrency, right? But it's difficult because if you read the Seattle, this article on Seattle, on the Seattle Times, right? Then the guy, you will talk about the guy, and he had to do a whole bunch of things to basically. He's a trader. He traded Bitcoin and other cryptocurrencies and made a lot of money, right? So he wanted to cash out, buy a house. So he had to prove to the bank that he was a trader. He didn't acquire the cryptocurrency in an illegal fashion and that kind of thing. He jumped through a couple of hoops, right? So it's still difficult, right? You have to be determined if you actually want to buy stuff in real life with cryptocurrency. Okay, so what is FundPlaces doing, right? So, as Brian mentioned previously, what we want to do is we want to bring down the minimum investment amount for real estate investments to $1,000. Okay, so the technology we employ is the same technology underlying the Bitcoin blockchain, right? It's a private blockchain with support for asset issuance, and streams, which means that you can store some data on the blockchain as well. And of course, what we issue is the tokens that we issue are called tiles, okay, and they represent all the economic benefits of the asset, right? So you have a contractual relationship with the holding company which holds the investment. And the reason why we use blockchain is because it reduces our time and cost. So before we actually went full onto this, we did like a normal deal where you get people into a SPV and all that, and Marianne spent a significant amount of time actually trying to get everybody to sign and all that kind of stuff. Whereas, for when we close a deal there, basically you invest and then you just close the deal. Boop. Done. Alright. Easy and of course the thing about blockchain is that you still got this blockchainy goodness kind of stuff, right? Where you can easily transfer assets from one person to another. That's another reason why we use it. And of course, for the good old regulators, there's a audit trail, so everybody knows where everybody's money is going, right? So, what else does a blockchain give you? Right? Some people would say that, but you can do all of that without a blockchain. Well, this is one of the things you can't do without a blockchain. Right? So, the idea behind our platform is that, so remember I told you peer-to-peer network, right? So the idea behind here is that different entities can plug into the same blockchain, use it. And what they can do is that they can then trade assets cross-border, across institution. And as you can see here, right, so the names, the real names, personal identification, personally identifying information of institutions' clients, do not have to be revealed, right? So, and this would help to open up like other investment avenues. So, for example, you could possibly have a partner in another country sourcing for various investments, but you could then still sell those investments on, or our customers could still buy those investments, so on and so forth, right? Okay, any questions? Okay.
How's this different from a REIT? Conceptually.
Okay, so for FundPlaces, what happens is you are allowed to pick what investments you invest in, as opposed to a REIT. REIT is basically the REIT manager just picks the investments for you, right? So you can decide to invest in particular investments. Each tile represents a part of one particular investment. But I mean, Brian, you want to add on?
No, I think Stephen explained it pretty well. Essentially, if it's a REIT concept you're thinking of, it's like a single asset REIT. So every tile you invest in just gives you the economic rights to one particular asset which you've chosen. Whereas in a REIT, it's typically over a distributed, say 5, 10 properties that you get getting the cash flows from.
Right, so in that sense, it's basically exactly the same as a REIT in that an entity owns the asset and issues partial ownership in that asset. It's just that a REIT might own 10 assets, but the partial ownership is all the units that are issued, that are traded.
Yeah.
So which is the entity that owns the asset?
Yeah. Right now, all the assets are held by one single entity. It's called FP Tiles. But going forward, we're going to sort of split it up as our deal sizes get larger. So each project will have a separate SPV that will hold the assets.
And so the asset is acquired and then sold, basically. So the asset is acquired and then turned into tiles, and then the tiles are sold.
That's right. The SPV issues the tiles, which will fund the acquisition of the underlying project. Yeah. Most of the time, so quite a few of the investments that have been made are in development projects. So these typically, the funds go into the SPV. SPV will invest into the development project. Units are sold, say it's a residential development, units are sold, cash flow comes back, and then the SPV will then redeem the tiles that have been issued. So we make an offer to buy back all the tiles that have been issued.
Okay, yeah.
So it basically means that you have economic right, but you don't have the title of the place, right?
That's right.
Which means that hypothetically, if things go wrong and the bank, for example, forecloses on it, hypothetically, that means you wouldn't actually have access to, it could go bankrupt, so to speak. There's a risk of that happening.
It's possible, but we don't actually take any debt at the SPV level. So even if it's a purchase of a completed property, it's fully in cash.
Ah, okay. Okay, but for the returns that you're giving out, the property itself has a loan. Is that correct?
So if the investment, so there are three, I think Stephen has now showed
Yeah,
sort of three different types of investments. If it's an investment to a completed property, right, then in that case there's no debt at the SPV that holds and issues the tiles, holds the property and issues the tiles. Another type of investment is, for example, where we provide, say, financing to a developer. So the SPV, right, would issue a loan to a developer, right? And yes, at the development entity, that entity would subsequently also take on additional financing through loans.
But economic rights will only be in the SPV that's above, so to speak. Right?
Only the one on top, right?
So the income that the asset generates, say by a hotel, how does that flow through to the tile owners?
We issue whenever there is a issuance, say there's distributions right from the operating of the hotel, we actually issue something called SGD tokens. Yeah. So these are issued to the tile holders. So each of you would have a wallet on our platform, and the wallet would hold your tiles, and then we would then issue it to wherever the tiles are being held.
Yeah, well, I mean, basically we use the term nowadays called airdrop, right? We just airdrop the returns to all the tile holders.
And so the SGD tokens are that's Singapore dollars essentially.
That's right.
Yeah. Okay. So in essence, you've gotten rid of all the paperwork that potentially goes with it.
We also.
Okay.
Tiles are tokens, but not shares. So
Tokens. That's right, tokens, not shares.
So there's no legal title for the property.
There's no the SPV holds legal title of the property, and the tile holders have a contractual relationship with the SPV.
So in event, let's say you provide a loan for a development. If the development were to go under, okay, first, what position do you take? Second charge, but
Yeah.
and then if it does go under, then how do you ensure that the tile holders get or don't get?
So it depends. Each deal would be different. It could be if it's a first charge mortgage, then you're right in front, right? A lot of what we do typically is second charge. So in that case, the bank would be paid first, and then followed by us. We would act on behalf in the event, say there's a default, right? Then we would act on behalf of all the tile holders to execute on our security.
So there's a possibility that you may not
Yes.
actually lose out.
Correct. I think, yeah, like any investment, we're not guaranteeing the returns or anything. Every investment has risk, which we always clearly highlight.
What's the tax status of this? What are the tax implications of holding investment in tile?
Depends on whether you pay tax on your Bitcoin. So what happens is that at the SPV level, say we invested in a project in Australia, the returns there will be withholding tax on that investment, right? If it's a loan. So let's say it was a 10% that will be paid out. So then at the SPV level, we just only get 9%. When we redeem your tokens, actually, I consider that as a capital gains. So then, for me, I don't think there's any tax payable. But I always say check your wires or tax consultants. Yeah, not in Singapore. I'm just talking in Singapore context. Yeah.
Is the number of tiles for a particular SPV finite?
Yeah.
And can it appreciate the value of the tile?
Yes, so it's finite and you can appreciate. Right. But it's never going to, because it's asset backed, it's never going to have the kind of returns that you see for your other crypto assets. There's always like an anchoring value to it. So you should always expect it to be close to what the underlying investment is worth.
Does that mean that FundPlaces is always the market maker? They always have to provide a market for, if I want to sell my tiles back, does that mean you are playing the market maker, or how would that work?
Not now. So right now, in terms of on completion of the project, yes. So on completion, the offer is made to buy back all the tiles. But during the life of the project, say you, for whatever reason, you needed some cash and you wanted to sell your tiles, then that would depend on whether or not there's anyone actually on the buy side. So right now we don't actually market make.
Okay, you don't market make, but then there is a platform, a marketplace
Correct.
where you can put it out.
That's right. There's a platform where you can actually say you want to sell your tiles, or you want to buy tiles.
Okay.
So in theory, if I bought for $100, let's say, and I was expecting a 10% return at the end of a year, so 6 month mark, theoretically, my token is worth $105. If I wanted the money, I could offer it out there for someone to buy for $103. They then get a better than a 10% return. I'm getting slightly less, but I get my cash back, which is what I want.
Correct.
Okay.
So will all the tiles be the same value because you invested in assets, right? So technically, the value of each tile is different across.
What we do is we normally we fix the initial price. So for example, if the project is 1.5 million, right? Say we will issue 1.5 million tiles, and each tile is worth $1. So that's what we normally do. We normally vary the number of units and fix the price at 1 in the currency that we are investing in. So if it's Singapore investment is SGD, Australia is AUD, and then say it's in sterling, it's GBP.
So why can't I do this on a centralized database?
Why can't you do this on centralized database?
Because the middle part is essentially just database, and you can still do an API call to other databases.
Yeah, but with centralized database, what happens is that somebody is controlling this entire portion right here. This entire portion right here.
Okay.
Somebody's actually controlling this entire portion right here. So what happens is when you connect to the blockchain, right, then there's no central authority, right? So technically, if you can do what you want and I can do what I want, basically it's like a shared space.